Good day, everybody. Steve Garai with Remax Action, and once again, I have the immense privilege to have Fouad Wafdi with us today. If you recall, Fouad is the mortgage specialist at the Toronto Dominion Bank. Welcome again, Fouad.
Thank you, Steve. How are you?
Very good. Thank you very much. Happy New Year.
Same to you. Thank you.
And it is, the 15th of January, actually, of 2018. And we are now under the new regime, the new interest rate regime, and this would be the ideal opportunity for you to summarize everything for us once again. So I've received 4 or 5 questions specifically regarding this. Would you mind if I were to ask you these questions?
No problems at all, please.
Thank you. So the first question is, when do the new qualifying rates go into effect?
Well, it already started on January the 1st, 2018, and it concerns the conventional mortgages, meaning people that want to qualify with a 20% and more down payment. So it's only conventional.
So it applies to conventional mortgages. Very good, with 20% down.
That's right.
Second question, do the new rules apply to all lenders?
It certainly does to all federally regulated banks, such as our bank, TD, and all other lenders that are federally chartered.
Makes sense. Third question, how will the new qualifying mortgage rules impact the loans that are already in the process of being approved?
Well, look, the application that started before January the 1st, they're still good. They are good for 180 days. So we have like 6 months for those applications to still go in effect and still be able to apply the old rules.
Excellent. So 6-month grace.
6 months, yes.
Fantastic. Next question. How will, yes, in this case, this lady has a flex line application, which is your line of credit, right, at the bank. How will these new qualifying rules impact her?
Well,
after January 1st.
After January 1st, the way we qualify people for flex line is different. The mortgage also, for the flex line, we qualify people based on the credit line rate plus 2%, versus the mortgage, which is the posted rate, which is the client's rate plus 2%. Those two are compared to the benchmark, which is 499, whichever is greater.
So essentially, it's the exact same concept, except you're using the line of credit rates in effect, and one has to qualify on the highest of the two, correct?
That's correct.
And that's the amount of financing available. Last question, Fouad. Well, I think you've explained some of this, but this person wants to know how does this change impact a customer's borrowing ability?
Well, I can give you guys an example to be more specific, because this would show us how it affects the borrowing ability. Let's say, for example, somebody who wants to know how much the bank can qualify him for in the old regime and the new regime. In the old regime, let's say, for example, the interest rate was like 3.39, and he wanted to take a conventional mortgage with $100,000 down payment, with a $700 monthly debt to cover. So we were able to go get $500,000 for this client, as $400,000 mortgage and $500,000 house purchase price. Under the new regime, we lost about 15% purchase ability. So he can only go get $425,000 price for the purchase of his house. So with the new regime, we qualify him with his rate plus 2%, which makes us lose about 15% of the purchasing power.
Indeed, yes. So 15% reduction, in this case, in your $75,000 less for which you can qualify.
Right.
Okay, Fuad, well, listen, thank you so very much for all this information. Happy New Year to you and family
Same
once
to
again.
you, my friend. Thank you, and enjoy the rest of the day. Thank you.
It's very kind. Look forward to see you next time.
Thank you.
And you too, dear viewer, thank you for having watched. Until next time.